So you've got some stocks in your portfolio. You're probably doing what most of us do, waiting for them to go up in value. But what if I told you that while you wait, those stocks could be paying you? Today, we're diving into a really popular strategy that can turn your stock holdings into a source of regular income. Seriously, it's kind of like collecting rent on shares you already own.
Think about it. Most of the time, our stocks are just sitting there. They're valuable, for sure, but they're not exactly pulling their weight on a day-to-day basis. We're going to break down how you can put them to work and make them actively generate cash for you right now.
Let's use an analogy here. Imagine your block of shares is like a rental property. Of course, you want the property value to go up over the long term, right? But in the meantime, you also want a tenant in there paying you rent every single month. That is the exact idea behind a strategy called the covered call.
So here's our game plan. First, we'll dig into this whole idea of renting your stocks. Then we'll cover the absolute basic terms you have to know. After that, we'll walk through a real-world example, step by step. Then we'll get into strategy, talk about the risks, super important, and finally help you figure out if this is actually a good fit for you.
Okay, section 1. What do we really mean when we say rent out your stocks? Well, this is the magic of the covered call strategy. It's a fantastic way to generate income. And what's really interesting is that it's considered a conservative strategy because, in a way, it can actually lower the risk of just holding the stock by itself.
So here's the official setup. For every 100 shares of a stock you own, and that's the magic number, 100, you can sell one call option contract. Now, the most important word here is covered. All that means is you already own the stock. This isn't some wild speculation. Your end of the bargain is already secured or covered by the stock you have in your account. So why would you even do this? What's the big appeal? Well, first and foremost, you get paid that consistent income. That's the rent we've been talking about. Second, that cash you collect provides a small cushion, a little buffer if the stock price happens to dip. And maybe best of all, this is a conservative enough strategy that it's actually allowed in most retirement accounts, like IRAs. Now, to really see how this works, we need to get comfortable with just 4 key terms. Don't let the jargon scare you off. I promise we'll make this super simple. First up, the call option itself. This is the contract we're selling. For the person who buys it from us, it gives them the right, and this is key, it's not an obligation, the right to purchase 100 of our shares at a price and on a date that we all agree on beforehand. They can use that right, or they can just let it expire. It's their choice. Okay, so that's the buyer's side. What about our side of the deal? Well, as the seller, we have the flip side of that right. We have the obligation. If that buyer decides, yep, I want to use my right to buy those shares at that price, we are contractually obligated to sell them our 100 shares. That's the deal we made. Now, that agreed upon price has a name. It's called the strike price. It's the fixed price where you agree to sell your shares if the buyer wants them. And you get to pick this price, which, as we'll see in a bit, is where the real strategy comes in. And here it is, the best part. For taking on that obligation, for making this deal, you get paid. And you get paid right away. That payment is called the premium. It's cash that goes straight into your account, and you keep it, no matter what. It doesn't matter what the stock does next, that money is yours. It's your compensation. And finally, every contract has an end date. We call this the expiration date. The buyer has from now until that date to use their right. If they don't, the contract just, poof, it expires. It becomes worthless, and your obligation to sell your shares completely vanishes. The deal is over. All right, enough theory. I think the best way to really get this is to just see it in action. So let's walk through a super common, real-world example and see how all these pieces, the strike price, the premium, the expiration, all fit together. The process itself is actually beautifully simple. You can boil it down to 4 steps. Step 1, you gotta own the stock, at least 100 shares. Step 2, you sell that call option. Step 3, you collect your cash right away. And step 4, you just wait and see what happens when the expiration date rolls around. Okay, let's set the stage. Let's say you own 100 shares of Apple. You bought them a while back for $160 a share. Today, the stock's trading at 170. You're feeling good about it, but you don't think it's going to launch to the moon in the next month and a half. So you decide to sell one covered call. You pick a strike price of 175 that's above the current price and an expiration date 45 days out. For making this deal, the market pays you a premium of $2.50 per share. Since one contract is for 100 shares, that's $250 total deposited right into your account. And I have to say this again because it's the most important rule of the game. The second you sell that option, that $250 is yours. It's yours to keep. It doesn't matter if the stock goes up, down, or sideways from here. That cash is your immediate profit.
Now, here's something really cool about that premium. Think about how it affects your original investment. You got in at $160, right? But since you just got paid $2.50 a share in cash, it effectively lowers your cost. Your new break-even price on those Apple shares is now $157.50. That's that downside cushion we were talking about. Okay, let's fast forward 45 days. We've arrived at the expiration date. The fate of our shares, our whole trade, now comes down to one simple question. Where is Apple's stock price compared to our 175 strike price? And from here, there are really only three paths this can take.
Outcome A. This is the one you're usually hoping for. The stock closes at $172. That's below our 175 strike, so the buyer has absolutely no reason to use their right to buy it for more than it's worth. The contract just expires, worthless. What happens to you? You keep your 100 shares of Apple, you keep the $250 premium, and guess what? You're free to do the exact same thing all over again next month. It's the perfect income scenario. All right, now for outcome B, the stock had a great month and rallied all the way to 180. Because the price is above our 175 strike, the buyer is definitely going to exercise their option. Your broker automatically sells your 100 shares for $175 each. Now, you still keep that $250 premium. You made a total profit of $1,750, which is great. But here's the trade-off. You missed out on all the gains above 175. That's the opportunity cost of this strategy.
Finally, outcome C. The stock dropped. Let's say it's down to 155. Just like in the first scenario, the option expires worthless because the price is below the strike. You keep your 100 shares, which, are now worth less, and you keep the $250 premium. But look at how that premium helped. Your stock dropped by $500 from your original purchase price, but since you collected that $250, your net loss is only $250. It softened the blow. It acted as a buffer.
So as you can probably tell, the outcome really hinges on the choices you make at the very beginning. Picking the right strike price and the right expiration date, that's the real art of this strategy, and it all comes down to what you're trying to accomplish with the trade. Choosing your strike is all about trade-offs. If your main goal is to keep your stock and just earn a little income, you'd sell what's called an out-of-the-money call, just like our Apple example. The premium is lower, but so is the chance you'll sell. If you want to maximize your income and you're totally fine with selling the shares, an at-the-money call offers a much higher premium. And for the most income and the most downside protection, you can sell an in-the-money call, but you should go into that trade fully expecting to sell your shares. You also have to choose an expiration date. You could go with short-term weekly options. They can offer higher returns if you add it all up over a year, but it means you're managing your positions every single week. On the other hand, you could use longer-term monthly options, say 30 to 45 days out. They give you a bigger chunk of premium per trade and are much more of a set-it-and-forget-it approach, which is honestly great for beginners.
Now, let's get serious for a minute. No investment strategy, and I mean none, is free money. It is absolutely critical that we talk about the risks and the trade-offs here. We have to be clear-eyed. This is not a strategy to get rich quick or to avoid all losses. It's a strategy to generate income, plain and simple. And let's be crystal clear on this one point. Selling a covered call is not insurance. That premium you collect feels nice, it's a small cushion, but it will not save you if the stock market takes a nosedive. You are still, at the end of the day, a stockholder, and you carry all the risks that come with that. So let's just recap the two main risks. First, you cap your upside potential. If the stock just absolutely takes off like a rocket, you're going to miss out on those huge gains above your strike price. You're basically trading a potential home run for a very predictable base hit. Second, your downside protection is very limited. That premium only helps a little bit. If the stock crashes, you're still facing almost all of that risk. And there's a third, kind of a curveball risk you should know about: early assignment. Technically, the person who bought the option can exercise their right at any time, not just at expiration. This doesn't happen often, but when it does, it's usually right before the stock is about to pay a dividend. They want to get the shares so they can collect that dividend, which means you get forced to sell a little sooner than you might have planned. Okay, so we've covered the what, the why, the how, and the risks. The last big question is, who is this strategy actually for? Does it match your investment style and your goals? Let's figure that out.
This strategy is a really, really good fit if you're an investor who wants to squeeze some extra income out of stocks you're planning to hold for the long term anyway. It's for someone whose outlook is kind of neutral to maybe slightly bullish. You think the stock will probably trade sideways or just drift up a bit. But most importantly, you have to be genuinely okay with selling your shares at the price you choose. If you'd be heartbroken to part with that stock, then don't sell the call.
And that brings us to what I call the golden rule of covered calls. If you remember one thing from all of this, let it be this. Only use this strategy on a stock you are happy to own for the long term, but that you would also be perfectly comfortable selling at your chosen strike price. If both of those things aren't true, it's probably the wrong trade for you.
So I'll just leave you with this final thought. The entire covered call strategy, all the definitions, all the scenarios, it really just boils down to one simple question. Are you willing to trade a potential home run for a consistent paycheck? There's no right or wrong answer here. It's all about aligning your strategy with your own personal financial goals.